I'm very pleased to say that on either side of me, I'm joined by some very eminent experts, and I'm very much looking forward to hearing their opinions. If I move from one side, from the left-hand side of the table to the right, I have Mr. Philip Bouverat, who's Director International of JCB, and JCB, as you know, is one of the largest manufacturers in India. I have Mr. Raman, who is a whole-time member of the Security and Exchange Board of India, which is the major securities regulator in India. On my immediate right, I have Mr. Rakesh Mohan, who is an executive director of the International Monetary Fund and the former deputy governor of the Reserve Bank of India and a former professor of Yale University. And finally, last but not least, I have Mr. Ashish Chauhan, who is managing director and chief executive of the Bombay Stock Exchange, which, as you know, is the preeminent stock exchange in India. The topic that we're going to be debating today and discussing is India opportunities for establishing closer ties and deeper cooperation in financial services between India and the UK. Obviously, it's a very interesting time in India. It has been quite an interesting time, actually, since the election of the Modi government in May of last year. But latterly, we've seen quite considerable activity in the financial services sector, particularly. This budget session a few weeks ago saw the enactment, after a considerable period of waiting, of the Insurance Act, which we will no doubt be discussing, which raises FDI limits, foreign limits on ownership of insurance companies from 26% to 49%. And we've already seen an announcement come out from Bupa, which has a joint venture with Max Group, that they are going to raise their level to 49% as soon as possible. And we expect to see similar announcements coming out from others, including Standard Life. At the same time, we've seen the setting up of the India-UK Financial Partnership, which is a dialogue that has been initiated between Minister Jaitley on the Finance Ministry and our Chancellor of the Exchequer. And it's a business-led initiative in which a number of topics are being debated and discussed, which hopefully will lead to a similar liberalization and internationalization of the rupee, as we've seen with the renminbi recently. So there's a lot of activity and a lot of debate to be had. What I'm going to do is I'm going to ask each of the panelists to speak for 5 minutes on addressing the topic. We'll then have a short debate. As mentor, I'm allowed to ask my own questions, so I'm going to exercise that right. And then we will throw open to questions from the floor and the audience. And I hope that that's going to produce some lively questions and answers. So without further ado, if I can ask Philip, please, to give his 5-minute address. Thank you.
Good afternoon, everybody. I know you've had 2 days of this, and I'm sorry, but I'm not going to address the subject at all, Richard, or the topic, because JCB is a manufacturing company. What I'm going to share with you is our journey in India and how we view the current situation and how we look at the future since the Modi government came in, particularly in the light of the last budget. As a manufacturing company, we've actually been producing yellow machines that dig holes, originally starting in the United Kingdom 70 years ago. The interesting thing is we've been in India for 40 years, initially in a very difficult market as a joint venture, and we gained our independence in 2003, and our own company was formed in India, run by our Indian management team. I know you've heard from experts on China, and you've also heard from experts on Africa today, but we at JCB firmly believe that India has a unique and very important place in the future world order as far as infrastructure and construction is concerned. We've built more plants in India than we have in any other single country outside the UK. Out of the 23 large plants that we have around the world, 11 are in the UK. The next largest cluster are India. In fact, the last two factories, which we commissioned in November, we started planning about 3 years ago, are in Jaipur. And for those of you who need just a very quick geography lesson, Delhi, Jaipur, and Mumbai are all on a line, and they're known as the cluster of towns, and they will form part of what is shortly to be called the DMIC, Delhi Mumbai Industrial Corridor. We've chosen this corridor, firstly because of the supply chain movement along it, but most importantly, its ability to export to the neighbours. Africa is a fantastic position just west of, obviously, the port of Mumbai, and the diaspora who operate businesses, particularly in South and Southeast Africa, are extremely well disposed towards India and India to them. Within India, it's our original market. We've got 50 dealers in India, and we've got 850 service outlets. We cover all 30 states, and we've been growing this at some speed, and we're growing our service outlets even further. A recent phenomenon that you may have seen yourselves is the rise of Burma, or Myanmar. Not only has Myanmar had an effect on the rest of Southeast Asia, it has a stunning effect on India. Northeast India, which really was a cul-de-sac, a very large one, has actually started to blossom and bloom. There is now a land route right the way from Delhi, right the way through to Singapore. This is incredibly important because that edge on the right-hand side, the ASEAN market, will become India's backyard. It was restricted from being there before because of the block of Myanmar. I'll just talk very briefly about the Modi government. Investment in infrastructure came up very large. I mean, anything to do with building roads or highways or increasing airports or ports capacity is good news for us as a company. But it's also very good news that the Modi government has started talking about infrastructure funds and is really going to start opening the discussions and working the PPP model very hard. So I think there's tremendous opportunity for UK funds to invest in India. Arun Jaitley, the finance minister, was here a few weeks ago, and Richard Heald and I came up with some figures, which we actually just got off the internet because nobody had collated them before. Out of London funds investing in India, I think there are 12 funds that have investments totaling in the region of $9 billion US already. Now, none of them have got together and actually put this figure across, but we've put it across to the minister, who was actually quite surprised. Leading the charge on that, I think, was Apex and 3i, had substantial investments, and then there were some others, very normal household names in your sector that you'll recognize. For us, corporation tax coming down from 30 to 25 in the next 4 years in India is good news. Consistency of policy, or the appearance of consistency of policy, is good news. In any market, we look for stability, we look for a good domestic market, we look for good human capital. With GST becoming uniform and the Modi government really trying very hard to chop up the red tape, we think there's a tremendous future there. I'd like to hand over to my colleagues who can talk more your language. Thank you.
Thank you, Philip. Mr. Rahman, would you?
I prefer to stand because I've been sitting too much of my time last 2 days here. Thank you very much, and first of all, I have to thank the organizers for inviting me here. I'm also a member of the UK-India Financial Partnership of the Bombay Leg, and we had a very interesting meeting on February the 13th recently. Of course, the UK leg is led by Sir Jerry Grimstone of Standard Life, and the Indian leg is led by Mr. Uday Kotak, one of our outstanding young bankers. And the discussions were pretty interesting, and we zeroed on some 8 or 10 areas which could be the focus areas where we could share experiences and, we could seek some expertise and help from UK. I will just narrate a few of those with the background so that you can have a feel of what the point is all about. First is development of corporate bond market. In India, the corporate bond market has been increasing substantially, but then there are one or two very important characteristics of the Indian corporate bond market. One is that the access to the market is only available for the top-rated issuers. For instance, 70% of the entire outstandings in corporate bond market is AAA. And then out of the rest of the 30, 28 is for A and above. So which leaves only about 2% with ratings of A minus and below. So that's so there are one or two very important things. One, as an investor, for foreign portfolio investors, it's a good thing that, the issuers are all top class, so you can, without too much of a due diligence, you can take some amount of plunge. But from the point of view of capital market and the needs of the market, the challenge is how to give access to issuers of slightly below the A level. That is, how about the growing industries, growing companies, how would they access? The Indian financial market is extremely bank-driven, and I will come to that in a bit more detail when I will be mentioning about infrastructure too. But by and large, the entire access of funding is through the banking system. And the effort has been for us over the last several years as to diversify the access to capital through the capital markets also. Number two, we thought insurance has been mentioned by the moderator just now, and that is a very, very major development in India. 26 to 49 has been increased very recently in the recent legislation, and is a long-awaited legislation. This, I think, is going to mean people, it is widely estimated, different estimates indicate $5 to $6 billion in a very, very short while, and we expect a lot of activity to be happening there. The pension administrators also are governed by similar rules to the insurance companies. So for pension asset managers, etc., again, there's a good chance there is an opportunity for 49% in parallel to the insurance sector. One of the important things in India which now is being thought about is also developing a reinsurance sector. Because some of you, or a good number of you, would have read about the come into being of the GIFTs, that is Gandhinagar International Financial Center, which is being talked about. One of the major areas of focus there could be reinsurance. So maybe there is a huge opportunity for the insurance sector, and especially in relation to the reinsurance sector, to look at India. Pension management I just mentioned just now. So here is again a good opportunity, and of course India would like to learn about these best practices. We had a session previous session about the pension management. It's a huge, huge challenge everywhere. And of course India has a new pension system called the New Pension System, NPS, and that's going to be now, thus far the organized sector, the labor was, they never had an option. Now anybody and everybody can choose between the two pension systems. One is run by the employer and another one by the NPS system itself. The major difference being in the NPS, more amount of equity would be invested in the NPS. So there will be a different type of creation, and there is a big scope there. Infrastructure funding is, of course, a huge, big challenge in India. Last 10 years, there has been a lot of activity in India in the infrastructure market. Several new airports have been built. Frequent visitors to India, of course, you would have realized that a huge number of roads have also been built, but any amount which has been done is still a fraction of what we actually need. Now, there were some initially when the infrastructure movement started at about 10 years ago, there were two questions essentially before us as to who is going to fund, which are the institutions which will fund, and number two, what are the instruments with which the money will be raised. And although a lot of activity has happened, a lot of roads, bridges, ports, power plants have been built, the two questions which we had then continue to remain questions. Broadly, how we managed to handle was through the banking system. Banking system did a fantastic job in funding all the requirements, but then over a period of time, of course, there are issues concerning the bank funding because of the asset liability mismatches and these sort of things. And there were some little problems connected with some of the projects where the last mile issues were there. And so some amount of NPA pressure also built on the system. Now, of course, we have to find a solution to this funding problem, and the government of India in the budget, of course, has made a provision for 20,000 crores, which is not too much, but then there is a possibility of a leverage of 10. That's what I understand. Because so that amounts to a good corpus, and from there onwards, of course, we can start. The infrastructure has to be, again, funded by bonds. So here again, we come back to the issue of corporate bonds. So corporate bonds has several areas of significance with us. One little piece of information which I can give you is those of you who are familiar with the investment in India as portfolio investors, there are basically $81 billion is the limit, $81 billion equivalent, $30 billion being the government securities, which is full, and the rest of it is $51 billion. Just a year ago, the subscription by the foreign portfolio investors was just around 25, 26. At this point of time, of course, it is more than 75. So there is a good amount of interest from foreign investors, portfolio investors into the corporate bond sector. Now, of course, some solutions should be emerging as to how we would do the infrastructure funding, what sort of additional type of bonds which can be issued, et cetera, et cetera. Divestments is a big issue, big portfolio, agenda item for the government. Of course, divestments have been continuously going on for the last several years in India. But the intention of the government now is to how to make it accessible to retail investors. I spent 4 years of my life in Jersey in 1983 to 87, and I was witness to Mrs. Thatcher's government divesting the first divestment of the British Telecom. I happened to subscribe to the share myself, sitting there. And it was such a thumping success. And we had several features like your golden share and then your loyalty bonus after 3 years. So a lot of things. I think the British experience in divestment is something phenomenal in my opinion. And maybe there is some scope for getting involved in the divestment activity in India. SME financing is also one of the major points. Of course, when I hear some of the program and sessions which I heard, SME appears to be a bit of a common problem almost throughout the world. But then in India, it is a problem. Again, it is all entirely bank funded. And once again, we have to find a way in which the SMEs can access the capital markets. Of course, I would request Mr. Chauhan to talk about it. There is a separate dedicated platform for the MSME, and the Bombay Stock Exchange has done a very good work there. Maybe I would request him to talk about it. But going beyond that, how can we enable them to issue bonds and this sort of thing? And internationalization of the rupee is one more big item in the agenda as a general item. In November 14, there was the first issuance of rupee-denominated bonds, which was listed in the London Stock Exchange. The issuance was by IFCA Washington. So we expect more and more such issuances in future. So by and large, I've given you a flavor of what are the areas of interest we thought UK and India could collaborate. And maybe we would have something more to say after some time.
Thank you very much, sir. Mr. Chauhan, can I...
Good afternoon. It's a pleasure to be in front of you. I think I will take the concept of India as an opportunity because it's a huge opportunity that is coming up. India is a very young country. It's 1.2 billion people. That's around 20 times larger than UK, all put together, including Ireland, Scotland, and everyone. And effectively, the GDPs of UK and India are practically pretty close now. UK GDP is around 2.378 trillion, and India is 2.04 trillion. So effectively, size of economy is similar currently in nominal terms, but the size of the population in India is very, very large. And out of that, 1.2 billion people, half are below age 25, and 65% are below age 35. So that's a huge sort of upsurge in terms of people coming into the job market, wanting to do a lot of things. They need to be skilled. They also need to be housed and so on and so forth. And there is an opportunity, as our Prime Minister says, that India has 3 Ds. That's the demographics, demand, and democracy. And these 3 you won't get anywhere. And somewhere that, for me, is a huge opportunity. The second part is most of the population is very technology savvy. Over the last 20 years, India has kind of figured out how to do technology. That's not only on information technology, which it is extremely good at, but also in newer technologies that is coming up, whether it's robotics, whether it's genetics, nanotechnology, wearable computers, and every kind of technology now Indians are extremely good at. So somewhere on the line, today India probably accounts for very small percentage of world trade and world GDP, but it's going to grow up very rapidly going forward. And that's, for me, the opportunity for everyone to look at India. India needs to invest in its infrastructure. Its infrastructure is basically quite bad in many ways, and it needs to invest in ports, airports, roads, bullet trains, power plants, every kind of infrastructure, and it can leapfrog. So there is a promise of leapfrog. 10 years back, India used to have, or probably 11 years back, India used to have 4 telephone lines for 100 people. It leapfrogged into mobile. So before the landlines came into India, mobiles came. And today we have 95 phones per 100 people. And so India is going to leapfrog into many of these areas, including infrastructure. And for me, there is an opportunity for UK because it is trying, especially London, is trying to compete with New York. Today, for many of us, many of our companies, the preferred destination for raising funds is basically New York. How does London become that much more attractive for people to come and raise funds, whether there are any taxation issues, there are any other issues, but effectively, today they get better valuation there, they get better name there, and so how do we resolve if India-UK partnership, where I am also sitting from Bombay leg, has to prosper. In terms of the Indian exchanges, the first stock exchange, BSE in India, was set up in 1875. It's older than Tokyo Stock Exchange. It's the oldest in Asia, and it's the largest in the world in terms of number of stocks listed. 5,600 plus stocks are listed. $1.6 trillion of market capitalization. And every day we get around 500 million orders. It gives you a response time of 200 microseconds. In 1 second, there are 1 million microseconds. And it has a capability to handle 500,000 orders in a second. So it's amongst the most sophisticated capital markets infrastructure anywhere in the world. It's ranked 7th best in terms of the investor protection, corporate governance, and so on and so forth. So effectively, the markets are pretty well equipped. They have a history of 140 years. And we trade everything, all instruments on the exchanges. That includes equities, equity derivatives, corporate debt, government debt, interest rate futures, currency, mutual funds, ETFs. Every product that comes, we actually trade. Recently, 3 years back, we launched an SME platform as SMEs create more jobs per rupees million invested. The government wanted the SMEs to come and raise funds for their legitimate needs. And BSE launched an SME platform. It's different from the AIM here. AIM platform is different in a sense that this SME platform is a part of the BSE structure itself. It's not a separate exchange, but it's a separate segment. So any company which comes into the SME segment, when it grows up, it grows automatically into the main board. It doesn't require to do anything extra to go from the small segment to the big segment, and that's how this is working out. Second thing is any investor, when he trades or he invests in a stock of SME or main board stocks, he goes through the same process, same members or same brokers, and same way he gets money or he gives money or gets security. So there is no process differential from the investor's perspective. In last 3 years, we have got around 86 companies listed on BSE's SME platform, and our SMEs are really, really small. Average, we are raising around 1.5 million US dollars. The company, when it is listing, the average market capitalization is around $6 million. So they are really tiny companies compared to the SMEs here, but they are growing up, and they are coming from all different shapes and sizes and industries, and we have a huge hope. Next 1 month itself, we think there are 20 more companies that are going to list. Effectively, it's a very different markets, but we have SMEs, really tiny markets, then we have large cap markets, and we trade every instruments that is available elsewhere in the world. So effectively, the regulator is very forward-looking. They were the first to come out with algorithms related algorithm trading or HFT related regulation. So the regulator is very technology savvy. The investors are technology savvy. Exchanges are completely automated, and nationwide, millions of users transact. In fact, BSE has 27 million registered investors. If we were a country, we would be probably 25th largest country in the world. And still, we have covered only 2% of India. We need to cover 98%. 27 million is a very small percentage of India's total population. And we need to basically get into the hinterland, get people to invest in the markets, and we need to learn from UK. I was sitting yesterday, I think 18% of the families in UK own financial instruments by way of investment in stock markets and so on and so forth. In India, it's only 2.5% numbers. So we need to reach out to not only foreigners today. India needs to invest around $2 trillion for next 7 years for infrastructure, for Make in India concept, for manufacturing, for services. And India can actually raise those resources from itself, but also it needs money from outside. At 2%, $2 trillion GDP, 30% savings, we actually save $600 billion a year. And 7 years' time, we will be saving $4.2 trillion, assuming no growth. If we assume a growth, then probably $5 trillion. And some of that will go funding infrastructure for India. But of course, we need to learn from you guys how to involve people to do nation building. Thank you very much.
Thank you very much. Dr. Mohan.
Thank you. Since I now sit in the IMF board, so I have a very macro view. I have not really been in touch with some of the micro developments in India, which I think Mr. Raman and Mr. Chauhan have given you a very good idea. So what I'll try to do is to give a macro view on why one might expect the financial sector to grow much faster in the next 5 to 10 years. First, after what I also referred to North Atlantic financial crisis in 2008-9, one of our reactions, along with the rest of the world, was to do a major fiscal stimulus. The consequence of that was the Indian fiscal deficit went up quite significantly, and it has taken us 5 years to start coming back to some reasonable degree of fiscal prudence. And now we expect the target is for the fiscal deficit to come down to around 3% of GDP by 2017-18. Now, the relevance of that is that as the government borrowing grew very significantly in 2008, 9, 10, and further, that the private sector got crowded out. And so among the developments where we might expect the financial sector to grow faster, and particularly for providing resources for the private sector to invest, is the fact that government will be borrowing less as a proportion of GDP. I think that's a very important development. We had actually come to that situation in 2007-8, but then you guys had your crisis. So we were affected by that as collateral damage, and so we were set back in that sense. So now we're coming back to some fiscal prudence. And the second thing is that along with the fiscal stimulus and also monetary stimulus in 2008, 9, 10, that the inflation went up to around 10% for 3-4 years. And that is also now coming down to less than 5% CPI, and actually negative in the producer price index. So we all know that when inflation goes up, the financial sector has difficulty raising funds. So with the two of these developments combined, that is fiscal prudence coming back, and with the new monetary policy framework of inflation targeting, etc., much greater confidence that inflation will keep low, then one might expect the financial sector to come back into action in terms of funding the private sector with much greater confidence in the next 5, 7, 10 years. Second, we have, at least over the last 15 years or so, had a very healthy savings ratio. It had actually gone up, domestic savings had gone up to a little over 35% by 2007-8. It has now come down to about 30%. But nonetheless, by global standards, 30% domestic savings is also very high. But financial savings have come down. Again, as inflation had gone up, a lot of domestic savings started going into gold. Now, again, with inflation coming down, with real inflation rates, so real interest rates becoming positive, one might also expect financial savings start going up. And again, all these things are sort of connected between the fisc, inflation control, and the financial savings therefore going up, and therefore going much greater possibility of the private sector being able to use the resources that are being freed up. One of the other points we make is that one of our characteristics has been through the action of the Reserve Bank of India, SEBI, and so on, that despite all kinds of volatility in global financial markets over the last 25 years, that we have always maintained financial stability through domestic actions. And so that's another point, that as the financial market grows, we can expect we have an institutional framework which has demonstrated its ability to maintain financial stability. Among the key policy actions now that are taking place, which again provide far greater opportunities, the first has been mentioned, that the new government is placing much greater emphasis on infrastructure investment. So, for example, the railways have announced an increase of 50% in the investment in this fiscal year, 2015-16, to something like ₹1 trillion, which is about 135. ₹1 trillion, something about $16 billion in this fiscal year, and the expectation of doing about ₹8.5 trillion in the next 5 years, which is about $135 billion. So that's just in the railways. Roads were also mentioned earlier, and one of the things that has been done there is that, taking advantage of the reduction in oil prices, that we've raised the fuel cess from ₹2 to ₹8 per litre. As you perhaps know, that the whole interstate highway system in the United States has been funded by the fuel cess. And we had not changed the fuel cess in the last 10 years. So this is also now providing much greater resources to invest in roads at all levels, that is, the national highways, state roads, and rural roads. Along with that, of course, the announcement that the government will be allowing tax-free infrastructure bonds. So one can expect much greater action taking place in terms of resource raising and resource application to infrastructure, particularly roads and railways. Again, in the same context, the government has also announced the corporatization of ports. Now, we have had a port trust structure, which I guess must have been taken from here at some point. But I think you probably all forgotten about it, because you certainly don't have port trust now in this country. But we must have taken it from you, because the act was 18-something or the other, if I remember correctly. So we also announced the corporatization of ports. And if one has the expectation of the kind of trade growth that we will have, we will need a very significant expansion of ports. And that will almost all be private sector investment in the ports. There's not been talked about enough, but I think that that's a very major development as well. Then in terms of increasing financial depth, the Prime Minister announced that he wanted at least that all households to be covered by bank accounts. And so apparently I think this entered the Guinness Book of Records, that our banks apparently were able to register 125 million new families in the banks within 100 days. So I'm told that now there's just about 100% coverage of all households in the country having bank accounts. Of course, many of them are non-operative. One has to say that, but nonetheless, it is a major attempt to increase the financial depth, and also so that many of the subsidies, etc., that are given to households can go directly to people's bank accounts without other intermediaries. Another big announcement is that we will do a new bankruptcy code. And this is very important for the financial sector. To my mind, it's been underemphasized that a lot of the risk-averse behavior of many actors in the financial sector is because we haven't had a functional bankruptcy code. And I would imagine this will also be useful for the development of the bond market, because unless you have an effective bankruptcy code, you can't, that when there is a failure, you can't get even 10 cents back or 10 paisa back. So one hopes that the government will indeed be able to put through this bankruptcy code, which should be very good for the financial sector. Another announcement has been made is a major development of insurance and pensions, trying to go deep down into the population. This has been mentioned by the other speakers also, but what I would mention there is that given that life expectancy in India is increasing quite handsomely, second, that with urbanization also going up fast, and hence the reduction of the number of households with joint families, which were effectively the social security system in India, that you might expect a huge increase in demand for life insurance products and pension products. And so this has again been mentioned by everyone here, and to my mind, this is one of the biggest things that we can expect in the next 5, 10, 15, 20, 25 years, is development of the life insurance and pension systems. And going back to infrastructure, that unless in infrastructure and bond markets, one of the things that have been missed by many of my colleagues who've been talking about bond markets the last 10 years, is that bond markets can't develop unless you have a good number of institutional investors. Retail investors don't invest in bond markets. Certainly not in the United States, I presume neither in the United Kingdom. So you can't expect to develop corporate bond markets, especially for infrastructure, unless there's much greater and faster development insurance and pensions funds. So to my mind, there's it's a combined activity that is providing social security to households, developing the pension and insurance fund industry, and hence you would then have an opportunity to develop the bond market and fund infrastructure. So I would stop at that. I've probably spoken too long anyway, which I tend to do most of the time. But I think that there are lots of things happening. I don't have knowledge about the UK-India financial partnership, but UK will have to compete with everyone else. So you better get your running shoes on. And India is usually a marathon, not a sprint.
Thank you very much. That was absolutely fascinating. Thank you for all the contributions. I think it is worth saying that the UK and India financial partnership dialogue has actually been going on for a considerable period of time. Just to contextualize, the UK is the largest G20 investor in India at this present moment, has been, in fact, for the past 14 years. And in fact, if you look at the FII flows going into India, then again, the UK is a major source of managed funds going into India. In fact, if you look at Aberdeen Asset Management, it's one of the largest asset managers putting money into India. Apex has 4 investments, I believe, in India, totaling $1 billion. And in fact, last week, I think it was, there was an announcement that Advent, out of their London office, had made an investment of $300 million into a single retailing venture. So there is a lot.
Isn't India the largest FDI investor in the UK?
It is.
Of all?
Oh, I think it's running about third at the moment.
Okay.
But it used to be the largest. So the amount of flows between UK and India is, I think, surprisingly understated quite often. But there are two questions that I wanted to raise. One was on infrastructure, which clearly is a big theme. And the first one I wanted to ask and address to Mr. Chauhan, actually, is on this inclusion, financial inclusion point. Because within the dialogue, that is something that is very much an imperative. And you mentioned the question of 900, I think it's 900 million handsets now in wireless handsets in India, if my memory serves me right. And just to put that in context, maybe about 10, 15 years ago, there were probably around about, I don't know, 5 million. So you've had a huge, great expansion and a vaulting. And one of the areas that we've been talking about in financial inclusion in the UK-India Financial Partnership is the use of technology in terms of spreading out. And we've heard about disinvestment and retail and trying to build up retail involvement in disinvestment programs. So my question is how do you see the evolution of technology in financial inclusion and how the UK and India can collaborate on that?
No, I think it's a great question. For me, India didn't go into computers at all, actually. It still has probably 30 million computers, which were there probably. In fact, many of them might have gone out of our service. But effectively, India straight away leapfrog from no computers to straight mobile-based internet and stuff like that. So there's a huge movement, and technology is enabling things which were not possible to do even 10 years back or 5 years back. Setting up a bank branch was a very costly affair. Today, people are actually running with mobile phones, even the bank employees, to hinterland and making those, he mentioned about 125 million accounts. Basically, that happened through the mobile technology in many ways, right? So effectively, there is a lot which you guys have done in terms of conceptualizing, executing in a physical world, because you were far ahead of us in financial inclusion, getting the population to do banking, invest in pension funds, social security, and so on and so forth. We were quite behind, but the structure is what you created. Now we need to use the structure to efficiently reach out to people using technology. And that's what our framework in India is. You don't get too much revenues per transaction. I get 500 million orders a day, one of the largest in the world. If I were New York Stock Exchange, I would be getting at least 100 times more revenue than what I get. So effectively, we get very little revenue for a lot of work because people are poor, and it's an extreme high value for extreme low-cost market. And that's where we need to use technology more efficiently than you have used till now. But we need to still learn the ideas of marketing,
right,
and structuring and so on and so forth.
Okay, people are poor. The Bombay Stock Exchange is not.
Again, the concept is small little revenues end up becoming very large at the aggregated level, right? So it happened in telecom. Our telecom charges on mobile are probably 1/10 or 1/20 of what they charge here. But because we are 20 times larger, the total aggregated revenues at the telecom vendor level, similarly in the exchange level, are pretty large.
Okay, thank you.
If you could add something to what Ashish was mentioning. India, because of India is actually two countries put together, one an extremely rich, extremely well-off portion, Another one, of course, extremely poor also, and then there is a big middle in the middle. So the point is, the cost is always, it's a very cost-conscious society. I'll just give you a little humorous thing. If I need to pass a message, in India there is a very popular expression called, give me a missed call. That is, I give you a call and then stop it. So I don't get charged. The other guy knows that I want to talk to him. So it's all new contraptions or new little ideas which come so that its costs are kept to the very minimum. India is a very cost-competitive country, but when going back to the mobiles, nobody thought actually it would spread the way it did. Because much of the sales have been to the very poor sections of people who had never handled any machine earlier. But then everyone handled it. So there is a huge hope that once the payment system gets going through the mobiles, and everyone is 100% sure that the same people who we think are not very good, they'll be excellent in using the same technology. Right now, again, if I were a poor guy coming from one corner of the country, say to Bombay, my main interest is to send remittances to my family. So now how is it getting done? The same poor fellow, he has found a way. There is an ATM card which is given, and the ATM, he does not have it, he has given it to that family member there, 1,000 miles away. So he puts the money here, and the next second, of course, the other guy gets it. So India is a society where it's a bit of a constantly innovating little things, but then this will be a very major move, and yeah.
I'm going to actually take questions now. I think, I don't know if there's a mic moving around, but this gentleman right at the back that I can see. Okay. If you could announce your name and company, and then...
Sure. Good afternoon. I'm Sunil Benimadu. I'm from the Stock Exchange of Mauritius. I've got a couple of questions for Ashish Chauhan. We've seen that over the last, I would say, 15 years, the equity market and the derivatives market in India have known exponential growth, and volumes, as you mentioned, have picked up. Number of trades have really shot up, making you, as an exchange, one of the most active in terms of number of trades on a daily basis. But at the same time, I know there's been a lot of efforts to develop the secondary activity on corporate bonds and government bonds. And as has been mentioned by you and the other panelists, this seems to have been struggling in terms of its development. So given that the institutional investors are very active on the equity market and on the derivatives market, and the retail people also are extremely active, so what explains, the relatively slow growth of the secondary market for bonds? That's the first question. Second, to you, Ashish, is you mentioned that you have 5,500 stocks listed on your platform. Any idea how many or what percentage of these are relatively actively trading on a daily basis? And what is it that the exchange is trying to do, or the brokerage community, so as to bring those 5,500, to scale up in terms of the trading activity, which would then really increase your volumes in a tremendous manner? And last question to you is about your SME market. Have you had any problems of compliance with these small companies listed? We know in London there's the concept of nomad, which helps these companies to comply with the exchange environment. So what is the case in India? Thank you.
Thank you for your questions. I think in government bonds, there is an interesting development that is taking place now. There is, earlier, the government bonds were part of the Reserve Bank of India's mandate to manage and monitor and regulate. From this month onwards, or probably next month onwards, because it's part of the new budget proposal that would be passed anytime this month or next month. What it says is that it is taking away the debt market, issuance of debt on governments, and the trading oversight from the RBI, and there will be a different public debt office that is getting created, and the regulatory oversight on that market would be with SEBI. So effectively, that's a pretty large change, and that would bring in huge number of investors. Till now, the RBI, which is equivalent of Bank of England, was in a sense using banks which were regulated by them to manage that market. Now, having it separated, you'll have many more institutional investors, retail investors, all of them participating in that market. Coming to the corporate bonds, each issue size is pretty small, and that's why the liquidity is not there. In addition, most of the funds which have been raised are into what we call tax-free bonds. For public infrastructure frameworks, the government companies, PSUs as we call it, public sector units, they come and raise the tax-free bonds so that people don't have to pay tax on the money they've invested. And they're in huge heat in a way that people buy and just keep it for 10 years, 20 years. So there is no secondary market in a sense because nobody wants to actually trade. They are very, very valuable for them so that saves them taxes and stuff like that. But we are pretty hopeful that once the government bonds start trading on exchanges in a big way and it becomes easier to own the government bonds by retail investors and institutional investors compared to the banks, we see there is a huge demand for government paper, and that will basically perk up the volumes on the secondary markets in debt. Coming to the issues of the active stocks in Indian markets, we get around 3,000 stocks traded every day, which is around 65% of the number of stocks traded. In a month's time, probably 3,500 trade, and in a year's time, around 4,500 trade. So effectively, out of 5,600, around 1,200 or 12 to 1,100 stocks don't trade even once in a year, but others trade and reasonably more frequently. We are trying to create market-making frameworks which were forgotten because of the automation. Automation in Indian markets went on what we call order-driven systems instead of market-making, and they have helped India achieve what it wanted to achieve, but now we need to create the liquidity into the tail stocks, and that's what we are trying to now work with the regulator on, how to create a framework, because although there is a perception of having infinite liquidity in all stocks, fact is in UK, US, there is no infinite liquidity in any stock. So depending on the market capitalization of the stock, you need to have a proportionate liquidity. Otherwise, it's basically a utopia. So we are aware of the practical situation where the small stocks will require smaller amount of liquidity for people to come in and go out. The larger stocks, that is where market capitalization is larger, you need to have larger chunks and so on and so forth. But effectively, the perception of having infinite liquidity in all stocks is slightly odd, but we need to sort of add the dose of practical reality and still bring in the liquidity that is necessary. In terms of SME market, it's young, around 3 years old. We have not yet faced the compliance issues because many of these companies were in some sense well managed. That's why they came to the new market. And most of them have shown growth. But once we have a longer experience, we might have some issues with the SMEs because SMEs also have the larger chances of failure compared to the larger companies which come to the markets. And we need to worry about when these companies stop having profits, their aspiration to also comply with tough regulations as given by the exchanges also comes down. So we need to kind of continue to monitor and manage how to sort of deal with this company as and when the issue comes up. Till now, we have not faced that issue. I hope this kind of satisfies your questions.
Okay, thank you very much. Yes. I think the lady here.
Hi, good afternoon. Celine Dong from London Metal Exchange. My questions from the panelists are commodity related, and in particular, I'll be interested to hear your views on what are the next best cooperation direction and opportunity you see between India and UK, particularly in the commodity sector. In yesterday's China panel, And we heard that in terms of speeding up internationalization of RMB, commodity pricing in CNH or CNY has been identified as the one first step. Would the panelists share the same view?
If I understood correctly, it's what is the first step in the dialogue? Is that right? So could you?
I didn't catch the question, sorry.
Sorry. So yesterday in the China panel, and we talk about the internationalization of RMB,
Yep.
which I understand has also been in the next initiative for the UK government and the India for the internationalization of rupees. So as the first factor that identified to speed up the process is to have the commodity pricing in CNH, in RMB. So would the panelist view share the same view for rupees?
So if I understand correctly, what is the first step in the internationalization of the rupee? In China, it was the first step was the pricing of commodities in renminbi. Would that be the first step that yourself, and I'm going to ask Dr. Mohan to comment on that?
I was referring to that one event, the first event of internationalization of the rupee, in a way, is the issuance by the IFC Washington. We permitted them to issue rupee equivalent of $1 billion for different maturities up to 10 years. So one or two issuances have already happened. And so that is where we have started. It is still in the infancy, but that is where we, so far as on a general basis is concerned, Indian rupee is fully convertible on current account, but on the capital account, it is by and large convertible, but not fully convertible. So, of course, in China also, you made some small starts, and now, of course, good amount of internationalization has already happened in renminbi. But we are still at the beginning stage. We have taken the first step, and the first issuance has happened. And this Indian rupee bond is actually listed in London Stock Exchange. So this is the first time any rupee instrument has been listed outside of India. So that is where it is.
Dr. Mohan.
I actually don't have that much to say on this, except that I think it'll take quite some time for internationalization of the rupee. I may be wrong. And I think China is certainly far ahead on that issue. I think one of the, among the problems that we will be facing is that given the extended zero interest rate or negative in Europe and the United States, and also the unconventional monetary policy, now the QE of ECB for some time to come, also of Japan, that the interest rate differentials being so high between India and the advanced economies, that the chances of a much greater liberalization of the rupee on the capital account, as Mr. Raman said, rupee is convertible in the current account. The chances of much greater liberalization on the capital account is not very high, given these developments in the world. We will have to keep the capital account under some kind of management. Otherwise, there'll just be a flood of speculative yield-searching money. So I think that given the current context, we'll have to be just watch and wait in terms of when it is feasible to internationalize the rupee on a sustainable and safe basis.
Okay, thank you. Do we have any further questions? Okay, I would like to ask Dr. Mohan one final question.
Oh, no.
Don't worry. It's on the question, we've heard a little bit on the question of governance, compliance. We've heard talks about introducing certain intermediaries like nomads, etc. The question that I have is about technology transfer, and particularly around training and learnings that can be transferred from, let's say, the UK into India and India into the UK as part and parcel of this increased collaboration and cooperation. Do you think that that forms a fundamental part of the dialogue between UK and India?
Well, as I said, I don't really know much about the dialogue, but I think that, as you said, the sort of exchange of training or exchange of information or exchange of capabilities in both directions would be very useful, because one of the things that is different today than 20 years ago, just because of the net, that everyone has access to the same information. And to some extent, my own experience is that what is much more useful is actual transfer of what you might call practice information, as opposed to theoretical information, because that is available to everyone on equal basis. But what is less available is, say, how a country, the UK, may have developed particular markets, what processes you went through in developing the markets, regulatory processes, and so on. And in your case also, after all, that in the last 10 years, last 20 years, you, in terms of financial regulation infrastructure, you went through the separation of the Financial Services Authority, found that led to all kinds of problems, so you now folded that back into the Bank of England. So I think that many of these kind of experiential learnings in terms of what you've gone through, also what is mentioned about the separation of debt management from the Reserve Bank of India. You also went through a similar separation. I think it was a bit early to mid-90s. I think when the Tony Blair government came in, if I remember correctly. So you've gone through all those steps. I think that these kind of issues that are very important, in that as we separate out debt management from the Reserve Bank to a separate agency, what are all the steps they'll have to go through? What kind of training will the new people need, and so on? I think that's the kind of thing that I would mention. On a very different note, before we end, I need to do an advertisement, which is those of you who are interested in infrastructure development, particularly transport. I had the privilege of chairing the National Transport Development Policy Committee, which is looking at the 20-year perspective of transport development, and covering all the sectors: roads, railways, civil aviation, ports, shipping, and also urban transport. Any of you who are interested in really looking at information, what needs to be done, what are the current expectations of expansion in traffic, the kind of investments needed in each of these sectors, you'll find that there's a document called the India Transport Report. And if you just Google National Transport Development Policy Committee, you'll find it. So just that those who are interested, just getting more of a perspective, or long-term perspective, what are the prospects in these areas? Philip, you should just go off immediately and buy the report from Rutledge, because it'll all involve Earth moving. So.
So I think that we've all been set our homework from that comment. But look, I have a red light flashing in front of me, and I really don't want my seat to get electrified. So I'm going to call this session to a close. I'd like to show our appreciation to the panelists and to answering the questions. So thank you very much yourselves, and thank you, gentlemen.